think venture capital is only for billionaires and Wall Street elites. Not so fast. Because today, I'm going to show you why that assumption might be holding you back. What I'm about to share could completely shift your perspective on how accessible venture capital really is for business owners and high net worth individuals like yourself. And stick around until the end because I've got a bonus tip on how to get your foot in the door with top venture capital firms, even if you're just starting out. I'm Rich Smith, and I help investors and business owners learn how to multiply their wealth by making smart financial moves. If you're unsure whether venture capital is something you should consider or even how to begin, you're definitely not alone. Today, we're breaking down exactly what venture capital is, how it works, and how you can start investing in it, even if you're new to the game. Many business owners miss out on massive opportunities because they think VC isn't for them. But once you understand how the process works, you'll see how you can make it part of your financial strategy. So, how does venture capital actually work? Let me break it down. Imagine a big pool of money collected from various investors. These could be institutions, wealthy families, or even high net worth individuals. The venture capital firm takes that money and invests it in startups they believe have massive growth potential. The goal is to find the next unicorn, companies like an Uber or Airbnb, and profit when those companies grow, go public, or get acquired. It's a high risk, high reward game. And the fund itself usually operates over the course of 7 to 10 years, giving those startups time to grow. VC firms invest in multiple startups, knowing that not all will succeed. The winners, those few startups that do make it, will ideally bring in huge returns that more than cover the losses of all the others. That's the venture capital model. You don't need every startup to succeed, just the right one. Now, once the investments are made, VCs don't just sit back. They offer guidance, connections, and sometimes even join the company's board. The real payoff comes when the startup, like I said before, either goes public, gets acquired, and either of those scenarios can lead to a big payout. So now that we understand like the basics of how VC funds work, let's do a little reminder about the key players, the limited partners, the LPs, and the general partners, the GPs. Now, I know I'm throwing around different terms and letters, so let me explain. LPs, limited partners. These are people like you and me, investors who provide the capital. Now, these can be large institutions. Think a pension fund, a wealthy family. But the past few years, VC investing has become more accessible to individuals. Now, LPs aren't involved in the day-to-day management of the VC fund, but they expect a good return on their investment and they trust the GPs to make the right decision. So speaking of GPs, the general partners, those are the ones who manage the fund. They decide which startups to invest in. They play an active role in helping those companies grow. Usually the GPs have industry experience, a network of connections, and the ability to help guide startups through the tough stages of growth. And when those investments pay off, both the LPs and the GPs share in the profits. The relationship between LPs and GPs is crucial. Limited partners supply the money, and general partners do the hard work of turning that money into more money. Together, they form the backbone of venture capital investing. So let's think about it. How does a startup go from an idea to securing venture capital funding? Well, it all starts with the pitch. That's where entrepreneurs, also called founders, pitch their business ideas to venture capitalists, hoping to secure an investment, and they need to convince the VCs that their startup has huge potential. This pitch usually includes their business model, growth strategy, and the problem their product or service solves. If the VCs are interested, they can start something called due diligence, essentially doing a deep dive into the company's finances, market potential, and risks. If everything checks out and they decide to move forward with the deal, well, then the investment terms are negotiated, hammered out, and that includes how much money the VCs will invest and what percentage of the company they'll own. And once the deal is finalized, the venture capital fund invests the money, and the real relationship between the startup and the investors officially begins. You see, it's not just about funding. VCs often play an active role, offering advice, resources, and connections to help startups grow. Now, let's talk about returns, what you can expect when you invest in venture capital. I mentioned it before, venture capital is high risk, high reward. It's an investment, and not every startup will succeed. In fact, many will fail. But the ones that do succeed can bring in enormous returns. Typically, VCs aim for at least a 10 to 15% annual return, but the real winners, they can deliver 5x, 10x, or even more on that initial investment. However, these returns take time. It can take anywhere from 5 years, 7 years, 10 years for a fund to mature and for those big payouts to happen. The key is patience. The successful startups often make up for the ones that didn't work out, and when they do hit, it truly can be life-changing for everyone involved. Venture capital is about balancing that risk and that reward. Like I said, many startups will fail. Competition, the market shifts, internal mismanagement can lead to a company's downfall. But the VCs, they accept this risk because the reward can be massive if the startup becomes successful. So the risk is high, but the payoff when the startup grows or gets acquired can be enormous. And that's why, let's be honest, VCs are so selective. They know only a few investments will make up for all the losses. So for the right investor, this high risk, high reward model can be extremely profitable, rewarding, and exciting. But let's zoom out. Venture capital isn't just confined to one country. It's truly a global industry. From Silicon Valley to Europe, Asia, and beyond, VCs are looking for opportunities everywhere. And the fundamentals remain the same, but each region offers its own unique risks and rewards. In places like the US, venture capital is well established, while in emerging markets, it's still growing. Global VCs look for opportunities in places where the potential for growth is high, but they also understand the challenges that come with investing in different various markets. A couple important considerations if you're seriously thinking about investing in venture capital. The first, choosing the right fund manager is critical. You want to back someone with a proven track record of successful investments, specifically and especially in industries you're interested in. You want to look for a fund manager who has strong connections and understands market trends. And hopefully, any good fund manager will keep you informed, make smart investment decisions, and eventually maximize your returns. Secondly, there are some important tax and legal considerations. I'm not going to get too far into the weeds, but depending on where you live, you may face capital gains taxes on successful investments. So I always recommend consult a tax advisor, your lawyer, before making any major investment decisions, simply to avoid surprises later on. Venture capital investing has been extremely rewarding for me personally, but it's not for everyone. If you're comfortable with high risk, long-term investments, and you're excited about backing innovative companies, then venture capital might be a good fit for you. But if you're risk adverse, and that's okay, there are much more conservative investing options you should consider. Ultimately, venture capital is about investing in the future. And if that excites you, it could be your perfect investment path. I'm Rich Smith, and I help investors and business owners learn how to multiply their wealth by making smart financial moves. If you're ready to dive deeper into the world of venture capital, check out the link in the description for a bonus tip on how you can get your foot in the door to the VC investing world. And I want to hear from you. What's a company you believed in before it was a household name? Leave a comment and let me know what topics you'd like to see covered next on this channel.